Good afternoon, everyone, and thank you for joining us. Welcome to another session today by Resources Future. My name is Minha Hanif, and I lead the carbon markets vertical at RF, and today I will be your host. So today's session is focused on a practical challenge that many project developers, investors, and climate practitioners face. That is, how do we quickly assess whether a carbon project opportunity is likely to generate enough value before we commit significant time and money to development? So, to help answer that question, Resources Future has developed a carbon credit investment screening tool. This tool is designed to translate carbon assumptions into investor-oriented metrics such as NPV, IRR, and payback period, and of course, potential exit values. This tool is live on our website and it is free to use. And we hope that you must have done a test run on it. But regardless, today joining us is Khurram Lalani, CEO of Resources Future, who will walk us through the tool's main features, its scope, decision areas, and of course, real examples to show you exactly how you can also apply it to your context. So by the end of today's webinar, we hope that this tool can support early stage carbon opportunity screening at your organization, business, or personal project. So before we move on to the demonstration itself, I'd like to spend a few minutes refreshing some key carbon market concepts. So let's begin with how carbon markets work. At its simplest, a carbon credit represents 1 ton of carbon dioxide equivalent that has been either reduced, avoided, or removed from the atmosphere. When we say carbon projects, these are projects that create such climate outcomes through activities such as renewable energy deployment, methane capture, industrial efficiency improvements, or nature based solutions such as afforestation and ecosystem restoration. So around each project is an ecosystem of participants. And of course, that means project developers who design and implement projects, standards and registries. They provide methodologies and issue credits. Investors provide development capital, and buyers purchase credits to support climate commitments or voluntary net zero strategies. So you might also hear several important terms throughout today's session, and these are good to have on your fingertips anyway. So this includes additionality, would the project happen without carbon finance, baseline, that is the reference scenario against which reductions are measured, verification is the independent third-party confirmation of project performance, issuance is the formal creation of carbon credits issued to your account on the carbon registry you're working with. So now that we have covered the what of the carbon markets, let's also look at how this works and where our problem statement arises from. Is my slide changing? I think it is. So this slide illustrates a reality that is often underestimated by newcomers to carbon markets. Carbon revenue usually arrives much later than carbon project costs. So a project may first go through a feasibility assessment and methodology screening. It then moves into project design, registration, validation, monitoring, verification, and finally credit issuance. So each stage introduces a cost. And these may include like technical studies, validation audits, monitoring activities, verification audits, of course, the registry fee and associated transaction costs. So many of these costs are incurred at times like years before the first carbon credit is ever issued. So, of course, many at times you don't even know how much a credit is worth at all. So, as a result, project developers and investors frequently face like a difficult question that is, should we spend this money today when future carbon revenues remain so uncertain? Um, So every carbon project ultimately comes down to this investment decision. On one side, you have the development costs of today, and as I mentioned, feasibility work, baseline studies, registration fee, and on the other side, we have the future carbon revenue. But the challenge is not simply just generating carbon credits. The challenge is often, determining whether future value of those credits is sufficient to justify the investment required to create them. I hope by now I have elaborated the gap that our screening tool addresses. It converts assumptions about credits, prices, timing, costs, and exit scenarios into an investment-oriented financial view. And that leads us to what you'll be able to take away from today's session. Khurram's demo hopefully will aim to provide a quick practical framework around this tool that you can use to justify a detailed project diligence project process. Sorry. So by the end of the session, you should be able to understand how carbon assumptions translate into financial metrics, screen carbon opportunities more efficiently before investing significant resources in the full development, compare different development pathways, including whole versus exit scenarios, identify the assumptions that have the greatest influence on project economics, and finally have a more informed conversation with investors, buyers, project developers, and internal stakeholders. Now, this is important to note, and I will repeat this, that this tool does not replace project due diligence. Rather, this is an early stage screening lens to help determine which opportunities deserve deeper analysis. So, with that context established, I'd now like to hand over to Khurram, our CEO at RF, who has led the development of this tool at Resources Future. Khurram will walk us through the investment screening tool, the underlying calculations, and of course, the practical examples. Over to you, Khurram.
Sure. Thank you, Mena. Really appreciate it. I think would very warmly welcome everyone who's joined here. And maybe I think again, as Mena outlined, this is not a screening. This is not a very feasibility tool that can replace a full-phased, robust feasibility. We have positioned this as a tool which comes in handy if it is used early, and it can outline and provide you the right kind of analysis right at the stage where you require it the most. So maybe I think a lot is being said about carbon, but what is most important is that carbon decisions require financial discipline early. And what does that mean? So I think three areas are important to highlight. A, it's a high stakes financial game. So typically we see that when it comes to carbon projects, pretty much all the project developers tend to invest heavily right at the start. So you would see, apart from the project dynamics, just when it comes to carbon, a typical cost is around $100,000. So if you are making or if you're thinking to develop a carbon markets project, you would essentially be investing roughly around 100 to $150,000 depending on the project complexity, and hence it's a high financial stakes game. So you don't want to jump into a carbon project without ensuring that the numbers look good and the numbers are in the right order of magnitude. If the numbers are not in the right order of magnitude, and this is something that we have seen a lot, project developers tend to take a leap thinking that, okay, we will be able to develop carbon markets. The concept looks very good on the paper, but when it comes to executing it, they tend to realize maybe 18 months down the road or 24 months down the road that numbers don't really make good enough sense. And hence, very important that we've got a good grasp on numbers right at the start. Second, this is great for pre-feasibility analysis. And I think what we are going to show you, the tool essentially helps where it is needed the most, which is typically at a pre-feasibility gap. Once you have identified the numbers make sense, you can essentially take the project to a more mature level, feasibility, and obviously, post-feasibility execution, and so on and so forth. But this is the point where you need the clarity the most, and hence this tool comes really, really handy. The last is investment readiness, and I think a lot of project developers would like to seek funding. They're looking to have some sort of funding just to make sure that they can start the process. And hence, but they struggle somehow to come up with the right numbers. So if you use this tool, you would essentially be able to get very detailed financial analysis. When you get those detailed financial analysis, typically when it comes to carbon markets, you can essentially take this to your prospective investors and show them the real numbers. So this is like discounted cash flow, very good, very complicated, very robust technical analysis that you can essentially show right up front so that everyone knows that you have the right diligence done earlier on. Um, so next slide. And again, just to iterate, I think it is very important. We can go to the next slide. It's very important that we will keep this very interactive also, today's discussion. So I think it'd be great if everyone has a laptop in front of them. And maybe when it comes to those exercises, we've got two exercises. I think you can just pretty much walk us during those two exercises, and you'll also see the live results. So I think it'd be great if you have your laptop or any of the tool handy with you so that you can also see and practice as we move along. So what the tool is and what it is not. So very important that we differentiate what it does and what this tool does not model. So what the tool models, it models pretty much all the major assumptions. You've got the price assumptions, the cost assumptions, delivery assumptions, price escalation assumptions, frequency assumptions. These are the kind of things that it models. And as a result, you also get to see your NPV, IRR, payback, hold versus early exit comparison, and so on and so forth. Just going to walk you through in a minute. What it does not do, and I think this is very important to note, it does not calculate your actual revenues from the project. So for example, if you're doing your FLU project, it will only be able to give you estimates on carbon credits, but not your actual sale of non-carbon revenue. So if your non-carbon revenue is electricity or crops or products or services, that is not what this model is supposed to do. It is again not a replacement of your full project model. So your project model, if it is waste, FLU, whatever, you would need a separate model. You would need a separate financial model to calculate those costs, capex, opex, and whatever that you need on the non-carbon financial side. On the carbon side, this model is pretty decent to work around. So again, all the legal allocations of delivery, right? We just want to make sure that we state this upfront with our disclaimer. This is not again a legal advice. This is just an early estimation of your carbon credits and how you can see different scenarios and sensitivities if they play out in your carbon revenue cycle. This is also not a methodology specific tool. We'll just come to that point in a minute. Next slide. So again, as you were saying, the tool is methodology agnostic. So you can essentially model any methodology here. You can model renewable energy, FLO, methane, waste, energy, others. You just need to have very basic parameters, right, when it comes to your carbon modeling, and you would essentially get those carbon modeling numbers with you, right there instantly. But again, as we said, it does not really replace anything which is on the non-carbon revenue side. So if you have a renewable energy project or an FLU project or waste project, that financial model is going to be separate from the calculations on the carbon side. Next slide. So how do we calculate credits? And I think the first answer that we have, the first input that we have in the tool is the carbon credits. And I think just a genuine question is, how do we calculate the first step? This tool does not really help you calculate a methodology specific volume or value of carbon credit, but you can do it variety of ways. For example, again, this is rule of thumb for now. But when we provide our feasibility analysis, we do it very holistically. We do it, as per the methodology. But that's something which comes at a little advanced stage. At this point in time, all you can do is maybe just to see broad reduction in emissions due to your project. So if your project is resulting in broad negative emissions, just pick up that number as a value, as the volume of carbon credits, and then start from there. Again, when you reach to a point where you require a good, robust number, that is where we typically deal with clients. We essentially take a deep dive, we understand the methodology, we undertake those calculations which are specified in the methodology, follow the equations, follow everything, and then come up with a detailed ER calculations. But this is not a detailed ER calculations. This is very preliminary. I think the best way to think about it is that you want to be 80 to 90% right. So if you're 80 to 90% right, that this is your project, it is going to result in this much of emissions reductions, then you are heading in the right direction. You can model your carbon revenues alongside it. Next slide. So I think before we just commence with the demo, I think this is how the roadmap demo roadmap looks like. So we've got a project profile. We will input assumptions when it comes to carbon assets. We will also input assumptions when it comes to carbon cost. We will put our assumptions when it comes to exit strategy. Do we want to hold credits through the life of the project duration, or do we want to sell early? If we want to exit early, there's a place in the tool that can essentially show you how you can exit early. It then results, it gives you a very detailed response when it comes to the investment snapshot. And at the end, it also comes with a client summary that you can essentially showcase to your prospective investors or whoever that you want to show it to. Next slide. So I think, and again, this is just the output when it comes to, we use discounted cash flow analysis. So this is where the model essentially calculates discounted cash flows. Whatever the inputs that we have given, it calculates the annual cash flows, discounts it, maybe models it for to 10 years, 15 years, 20 years, 40 years, whatever the number that you want to put in there. It then does discounted cash flow analysis, gives you back your NPV IRR payback, gives you also a strategy comparison, and then results in outputs. Next slide. And so, yeah, again, I think this is something that we will practice, but we have the price, the cost, the overall revenue, and the investment metrics to go by. And this is just more than, typical revenue of carbon credits is credits multiplied by price. I think this is going to be little more nuanced than, what we've normally seen in pre-feasibility stage documents. Next slide. So this is fine. We can move on to the next slide. Yes, so this is now demo one. What I would request, maybe I think if everyone can essentially log in to the tool that we have, and maybe I think we can keep this slide, but in the chat box, if we can just put in our tools live link so that I think everyone can also practice as we move along. So if you can go to this link, I've just send this in the chat, you would see it would take you to this the tool page, and we can essentially start with these assumptions. Now, maybe this is like a good model to start. And I think if everyone is ready, then maybe we can start off with project name. We can just input any project name that you like, maybe ABC Renewable Energy. I'm going to start with ABC Renewable Energy. The model life is 12 years. This is hypothetical, just purely assumptions based, but the idea is just to showcase how the tool essentially works. So we can input the model life as 12 years, annual credits of 15,000, starting carbon price of $7 per credit, price escalation of around 2%, whatever the starting carbon price that we will receive. Issuance is going to be annual. Every year we will have a verifier come in and essentially do the verification. We can go back to the year. And the investor discount rate is 12%. Maybe what I can do is, if I can show my live screen, and I think we can just take everyone through the live screen that we
Yes,
have.
sure.
All right, so let me know if my screen is visible.
Yes,
Great.
it's up.
All right, so maybe starting price per credit is around 7. I can't see the screen, so maybe Meena, if you can just help me out with the numbers that we have. Annual price escalation is 2%. Project life is 12 years. Issuance frequency is every year, and then the investor discount rate is, I believe, 12% or 10%. We can just quickly see.
It's 12%.
Yeah. So it is 12%. When it comes to cost assumptions, we could essentially input the investor cost assumptions, 400,000. Again, these are dummy numbers, so don't think that these are the actual numbers. You could essentially the numbers differ from project to project basis. I'm just going to take a 3% annual cost escalation over here. Validation cost is around 18,000. Verification cost per issuance is 7,000. Transaction fee, we say that any broker or any entity would essentially take a commission of 5% on credit sales. And then there is this another set of assumptions. What if you are a project developer and you've got a project which is going to last 12 years, but maybe you don't want to wait till 12 years, and what you want to do is you want to when you register a project, at year 3 you might just want to sell the entire inventory at a discounted price, and you could do that in any year. For example, maybe in year 3 or year 4, I'll input this over here as year 3 and allow exit sale. I'll just say yes. Expected price is around expected price, let's say, is around $6 if I want to exit early. So year 5 at $6. So let me take this as year 5, and I want to sell my all the inventory, even the forward inventory. This is going to be a forward sale. I'm going to sell all my inventory at a discounted price. Otherwise, I would have waited for maybe year 10, year 11, year 12, sold it at a price at that year, which would have been higher assumption wise. But I'm going to sell it, all my inventory, in year 5 at the price of $6 per credit. Is there any discount that I'm going to offer? Normally we do. If you want to model this also, you can essentially input any number. Do you think there is going to be a significant transaction cost? Whatever the transaction cost that you want to model in, maybe a typical good percentage is 5%. You can model 5%. And how much of the remaining credits that you want to sell. So here we have taken an assumption that the project developer says that I'm going to sell my entire inventory, 100% of it, in year 5. I'm not going to wait till year 12, and I'm going to sell 100% of my inventory in year 5 at the price of $6 per credit. Now, if I have inputted all these assumptions, my revenue assumptions, my cost assumptions, and my exit sale assumptions, either I can hold my inventory and sell it as I move along, or if I can just, early exit, take an early exit and sell all my inventory at once. If I do if I hit calculate investment screen, now my project name was ABC Renewable Energy. And if everyone has inputted the same numbers, you would essentially see that the whole strategy NPV is around negative 2,91,529. I hope I've taken all the right numbers and we've taken all the right assumptions. But the annual credits is 15,000 in the example. So I'm just going to model the exact number that we have used, and maybe I will again calculate. And if I take 15,000, then my whole strategy NPV is $157,000. My IRR is going to be 19.3% in dollar terms. If I hold all my inventory, the payback is around 5 years. I will generate a total credits of 180,000. My gross exit value, if I want to exit, now this is if I don't want to hold, if I just want to exit early, then my gross exit value is $630,000. The exit NPV is this. Exit IRR is 27.2%. Either ways, the overall IRR and NPV is attractive, and hence the screening view says that it is attractive. And the recommended strategy under both the assumptions that we have done is to go for an early exit, because it says that early exit strategies IRR is 27.2%. If I hold it, the whole strategy IRR is 19.3%. And hence it is prudent as a financial investment case for me to just exit and not really want to hold it out. And you can essentially do so. You will also, when you press the calculate investment screen, you will also see there is this narration description that you would that will a condensed summary will be provided to you. Essentially, it summarizes everything and just says that under the assumptions that we have written, the exit strategy is more lucrative, and hence the idea is that we should exit it early and not really wait for the hold strategy. Otherwise, in either case, the IRR and NPV is positive. So hold NPV is this, exit NPV is $258,000. Overall, the cumulative cash flows are this when it comes to hold strategy. It gives you a comparison on hold strategy as well as early exit strategy. Very useful for if you are at a pre-feasibility stage or if you are at an early investment stage. You want to essentially communicate that you have a thought out plan, and essentially gives you a thought out plan. You have thought as what would be the normal validation cost, verification cost, credit price assumptions, and in terms of strategy also, do you want to wait it out till 10 years, 12 years, or you want to sell early and exit whatever project that you have? The base case, the model recommends exit. And again, we also have then scenario analysis. So you can do scenario analysis if the price was not $7 as it was in our case. If it was $5, then the whole NPV was negative. And hence, if you see The recommended strategy is exit, exit. In this case, the exit IRR is the hold IRR and the hold NPV significantly more, and hence it is recommending that you should hold the strategy. You should hold your credits. If you want to see sensitivity analysis, you also get sensitivity analysis preview in terms of what will be the buyer haircut, 10%, 20%, 30%. Haircuts are essentially how much do you want to compromise on your credit price. Maybe at a market it is selling for $7. Are you willing to sell all your inventory for $5, for $4, for $3? What is the haircut percentage that you are essentially you're comfortable with? So the model gives you these answers as well. It also then provides you very detailed financial year-wise cash flows. So all the 12 years, it provides you with 12-year cash flows, and it gives you all the numbers that you need regarding your credit sold, revenue after fees, cost, net cash flow, and the cumulative cash flow. If you want to do early exit strategy, it also gives you cash flows on those. And essentially, it also lays out cash flows when it comes to your early strategy. Remember, in the early exit strategy, we said we are going to sell all the credits at a discounted value in year 5. And hence, it is showing that the exit proceeds are going to be $630,000. And that is where the project essentially ends for you. You have transferred all the rights to someone else, and that someone else is now the buyer and the holder of these credits. I just want to do a slight tweaking. Let's suppose if we change this number from 15,000 to only 5,000, and let's see what the impact is. So if I change the numbers from 15,000 credits to 5,000, you can see the impact yourself. The entire structuring essentially becomes a non-viable starting point because the NPV is negative, the IRR is negative, and the screening view essentially gives you a shout out that this project is not viable. It requires further structuring. So if any time that you see a red coming up, essentially tells you that this is not something that you should pursue, or maybe try and see if you can augment the price, reduce the cost, or maybe increase the quantum. We can do it in any other way. Now, for example, if the investor initial capital is not 400,000, but maybe 100,000, if it is 100,000, which is typically the case, and if I calculate my investment screen, it then goes on to show me that the project becomes attractive. So either I reduce my cost or I increase my revenue, and I can again see the two strategies play out, and that gives me a good value, as in where we stand when it comes to this project. So I'm going to maybe, if this is all right, we can quickly move on to the next screen. These are the results that we just discussed on the RE case. Maybe we can take another example. I'm going to change the numbers slightly. We've done a renewable energy, but let's try and model if this was an FOLU project, which is a long-term project. Now, again, FOLU project is typically the model life is 40 years. And if it is 40 years, let's try and see. I'm going to just delete everything, all the numbers here. And maybe I think we can try and see how the tool plays out, how the model plays out, and provides us, let's say, RF FOLU project. Annual carbon credits is 5,000. Starting price per credit is $25 per credit. Annual price escalation is around 4%. Project life is around 40 years. So this is, typically what we see in FLU projects. If it is 40 years, issuance, we don't really have issuance on an annual basis when it comes to FLU projects. So maybe every 3 years, the verification will take place. And our investor discount rate is around 10%. So we can just input 10 here. When it comes to cost assumptions, I'm going to redo the cost assumptions and so let's start with the cost assumptions. Initial investor cost is maybe $800,000. Annual operating cost is $25,000. Annual cost escalation, we can just take it as 3%. Validation cost is $45,000. Verification cost is $20,000. And transaction fee, we can take a lump sum 7%. Should we go with the exit strategy also? Let's suppose if we do. So allow exit sale, yes. When would be the exit strategy? We can say illustratively, we want an early exit in year 3 at $15 price. Normally the price is around, let's suppose the price is $25, but we want to just take it forward to a point where we say that, okay, all the credits that we have, we want to sell it early at $15 per credit. Now let's see what would be my impact. And year 5 exit price per credit is 15. Buyer haircut discount, I don't want to give any further discount. Exit transaction cost, let's assume that we can assume 5% of exit transaction cost. And do I want to sell 100% of it? I can do 50%, I can do 100%. Let's imagine that we have 100% of remaining credits sold. So let's review the assumptions. This is RF FLU project, 5,000 annual carbon credit. Starting price is 25. Annual price escalation is 4. Project life is 40 years. Issuance frequency is every 3 years. And if I calculate investment screen, now this is what it tells me now. Under the hold strategy, if I were to hold it out, $393,000 is my NPV at a discount rate of 10%. My IRR is 13.1%. My payback is roughly around 9 years. My total credits generated on those 40,000 on those 40 years duration of the project, it is around 200,000. When it comes to my exit value, if I give away all my credits at an early exit, I will have a gross exit value of $2.6 million. Net exit proceeds after all the expenses is around $2.4 million. Strategy early exit IRR is 27.8. So see this difference. Hold strategy IRR is 13.1%. Early exit strategy IRR is 27.8%. So definitely the strategy which is recommended by the tool is exit. And you can essentially say that, okay, the overall this project is quite lucrative, but maybe once we set up the project, once the project is there, maybe a better strategy is find a buyer at $15. Don't really wait it out till all the 40 years and try and sell it early, which is going to be financially more advantageous. Again, it provides all the description, RFFLU project. It will give you the entire summary, all the graphs, something that we have already discussed. And then the annual cash flow. So remember this, I think this is very, very important. It essentially gives you now the annual cash flows all the way till 40 years. So it is modeled everything till 40 years. So the last example, the modeling was only done till 12 years. Now that we have inputted that this is a 40-year project, it has done modeling till the duration of the project, which is 40 years, and gives all the detailed cash flows. So this is very, very helpful. All you need to do is just to, make a copy of it, attach it with your pitch deck, and maybe if you want to show it to investors, you can show the real numbers. In the early exit option, we decided that we will sell in year 5. So year 5, this is, this is the cash flows. It shows under exit proceeds, total cash flows, and cumulative cash flows. The IRR and PV is something that we have calculated from above. But essentially, this is where we are. You can change any price, any cost assumptions, any revenue assumptions, any future credit price assumptions, and exit strategy, hold strategy. It gives you a very decent amount of analysis, which is great when it comes to pre-feasibility stages. You also have an option to print and save as PDF. And if I do print and save as PDF, it just gives you a very neat summary. And all you need to do is to attach the detailed financial models with your pitch deck, maybe use the numbers, and you can use it for early stage investment access. A lot of project developers that we have met, they tend to struggle. They've got terrific ideas, great ideas. When it comes to like showcasing numbers, they tend to struggle, and hence this is, this kind of a tool. We really hope that a lot of project developers use it, and when they use it, they can essentially this becomes like a convincing argument. You can essentially convince your investors that you've got an additional revenue stream, which is a carbon credit revenue stream. The carbon credit strategy is positive. The overall project makes sense on the non-carbon side as well as on the carbon side, and hence, again, this is something that anyone can use now. Just to one caution before I hand it back to Minha is that this does not replace full feasibility. So I think it's very important. The next stage is that once you have done your calculation, essentially what you want to do, if you want to proceed, you would want to calculate your carbon credits in an actual manner. So this is where we help clients and we do um, detailed ER calculations, and those calculations are very, very important. So once you have those calculations, then essentially it becomes like a very robust project development scenario, because then you have a good enough financial model. You also have a very good ER calculations, emissions reductions calculations, which you can typically use in your methodology selection and then take the project further. So very happy to take any questions also, but maybe back to you, Mina.
Thanks, Khurram. I'll share my screen again. Meanwhile, we have a couple of questions in the chat. I was hoping if you can have a look at them. I'll share my screen in the meanwhile.
All right, so yes, absolutely. So let's take questions one by one. Farhan Aslam is saying, in case when an early exit strategy is attractive, are the future MRV cost or transaction cost already accounted for in the tool? Absolutely. They've been accounted. So you would see that in the tool there is the annual operating cost. And if you change, you can change the annual operating cost. It assumes that whatever your costs are, essentially accounts for those MRV costs and transaction cost already. Second question, yes, absolutely. You will all have the recording. But very happy to take any other questions as well. Good question. So I see Kamran Hanif has asked, how does the tool account for Article 6 corresponding adjustment? I think that's a great question, Kamran. We have not taken into account A6 adjustments for now. This is pretty much a VCM model at this point, but maybe I think in the next iteration we can also incorporate the A6 adjustment mechanisms, and why not? I think that's a good suggestion. We can definitely model in and incorporate this in the tool in the next version.
Okay, so I think we have covered this slide, what the tool returns in the investment snapshot. We just saw this. Then we have sensitivity testing turns a calculator into a decision tool. So we have one more question, I think, before we continue.
Sure. Irfan Ali is asking for FLU, the credit volume depends heavily on baseline and leakage. Absolutely. How should a developer estimate that number at screening stage? So you're right. I think some of the numbers are very easy to calculate. The baseline is very easy. For example, if it's a renewable energy number, the renewable energy is very easy to ascertain the baseline. When it comes to FLU, all the performance benchmark, the leakages, they all come into play. At this point in time, as we said earlier on, the tool is not really designed to give you a methodology specific carbon credit accounting. So I think that's something where you need to undertake those numbers, the baseline numbers, the leakages numbers, before calculating your financial perspectiveness. But you are right. I think we haven't really taken that into account. It's not a methodology specific tool, but once you have a number in your head, the best way to think about it is you want to be 80% right. You don't want to be 100% wrong. So if you are 80% right, you would essentially still be in a good position here. So for FLU, I think good benchmark, good assumptions would essentially help you. So maybe a 10% leakage, 10%, a good buffer, good leakage. Those kind of conservative estimates can essentially give you a good, robust starting point.
All right, great. I think we have pretty much covered all bases. So, while we take more questions, I thought I'd walk you through our services. So, RF has three basic products when it comes to carbon markets. The first one is our 11 parameter carbon feasibility. This is like a very rapid diagnostic test that we offer our clients. And the idea really is just to answer the basic question: is this project worth taking forward as a carbon project? So these are the 11 parameters that we assess regardless of the type of project. So project eligibility, project baseline, legal compliance, financial feasibility, project timelines. So we understand that some projects, when they come to us, might not need a detailed feasibility or even like a pre-feasibility. So for example, with renewable energy projects, it's fairly easy for us to estimate, the number of credits because the emission factors are very standard. But on the other hand, maybe if you're doing like a biofuel project or an FLU project, this is going to have like a very contextual setting that is, specific to you. So what was your baseline? What your maybe planting species are? How long will it take for the species to mature? So the idea of the 11 parameter carbon feasibility study is to give you like a complete roadmap on how you will be able to take your project from feasibility to registration. The next one is detailed technical and carbon feasibility. Over the years, we have done a number of these as well. So when should you be opting for this one? This is when you have not yet designed the project itself, regardless of the emission estimates, but it is a sort of a project that has a good offset potential. So for example, if this is a waste management project, perhaps maybe relating to methane, and it is fairly obvious that the project will have like significant source of carbon offsets. So we do provide this as a service as well, where we essentially do the end-to-end feasibility, both the technical feasibility of the project economics as well as the carbon feasibility, whether the project aligns with the given methodologies and the standards. And then we have the end-to-end registration and issuance support. So like I mentioned, maybe for a renewable energy project, you might get to miss out on maybe the first two feasibility or like a pre-feasibility, because we can give you like fairly accurate estimates of the number of credits that you might, the project might issue. So uh, when it's at that stage where we can confidently state, for example, in X amount of years you will generate this number of credits, it's more sensible to just go for the registration. And this is where RF comes in. We handle all of your project documentation, your methodology selection and alignment. There is a stakeholder consultation and safeguards model. This is something that is a given with any carbon registry or methodology. You must do a stakeholder consultation. Then validation and registry coordination. We handle all VVB interactions on your behalf. We complete the validation package on your behalf. Then we have the MRV framework preparations because, regardless of the project type, the number of credits that will actually be issued into your account will all eventually come down to how are you reporting your offsets and how can you trace back, to your claims to the actual the documents, that your project is generating. So we develop this detailed MRB framework for you so that you can optimize and claim the entire amount of offsets for carbon credits. And issuance and post registration support, of course, if there are any other technical clarifications during the process, so RF is there to handle them on your behalf. So that is it for us for this session. Happy to wait a few more minutes, maybe for any other questions that anybody might have. Everybody is more than welcome to go to our website, check out, the tool that we just discussed. We regularly publish blogs. We post our videos on our YouTube channel, and this is where this recording will also be published, hopefully by tomorrow. So I'll share the link with all of the participants in the webinar here with us today. All
All
right,
right,
great.
amazing.
Yeah. So our email and our contact is present in this slide. If you have any further questions or you would like to get in touch with us regarding any of your carbon project activities, please feel free to get in touch with us. Thank you so much.
Thank you, everyone.
Bye.